development side in terms of how ETFs grow this year and how they become, I guess, further segmented with each new introduction?
Sure. Well, we certainly look at product innovation as a continued key driver in the growth of ETFs. We certainly have seen trends over the course of the past couple of years that have evidenced the strength within the fixed income market in particular. We've experienced that at Guggenheim, and the industry more broadly has seen fixed income growth ramp up dramatically, certainly relative to equities, which got a head start on fixed income as it relates to the delivery within the ETF wrapper. So despite the fact that there are certainly storm clouds on the horizon within the fixed income market, we continue to see fixed income as a meaningful opportunity to grow the ETF business more broadly as an industry. And beyond that, with equity starting to now come more strongly into favor, we certainly believe that the equity pace of growth will continue to ratchet up in 2013.
On the fixed income side, last year the heaviest inflow was into corporate bonds.
Yes.
High yield had about 11 billion, corporate bonds 16 billion. Does that continue in terms of the allocations, do you think, this year?
We certainly see that happening. We actually have a suite of investment grade and high yield bond ETFs, which are called our bullet shares ETFs, and they're target maturity products with defined maturities, and they were our fastest grower last year, and they're one of our fastest growers through the first month of 2013. We're certainly taking a very constructive view as it relates to high yield and corporate bonds, and certainly the flows early in the year have evidence that that continues to be a trend within the business.
What happens if the stock market really rally extends even further? I mean, January is an incredibly strong month. The Dow hits 14,000, first time in years before pulling back a bit. Will you see less interest in some of those fixed income products as people again rush back into equities?
By relative comparison standards, we would probably see a little bit less interest, but keep in mind that the size of the fixed income market dwarfs the equity market globally. Absolutely. Certainly. So we certainly see that as fixed income continues to catch up to equity as it relates to the delivery via ETFs, that fixed income will likely maintain the pace. However, certainly as equities continue off of a very strong run here, like I said before, we expect that to grow. So again, fixed income versus equity, perhaps equity will begin to outpace fixed income, but we believe both will be strong growers in 2013.
What's the risk in investing in ETFs as opposed to just the single instrument?
Well, certainly the ETF comes as a packaged product, so there's an element of diversification there that is not available when you buy an individual security like a bond. So I alluded earlier to our bullet shares ETF, which deliver a suite of ETF products with defined maturities, and they provide diversified portfolios that provide not only just single security diversification, but also sector diversification as well. So goes back to that old theory of not all of your eggs in a single basket, and we certainly constructed those products with that single bond in mind so that we could position those as providing the best benefits available in an individual bond, but yet the added benefit of within a diversified portfolio.